Welcome to Money Hangout once again. Every week we talk about a question which is top of your mind, try and answer as many questions that you may have, and help you understand mutual funds better. This is brought to you by Birla Sun Life Mutual Fund and Value Research. Today we are going to pick, we have picked one question which most investors are asking today. Uh, how to invest in a hot market, or what to do now in a sense. Because the people who are invested, they are worried that they are sitting on hefty gains, and if the market corrects they will lose money. There are investors who pulled out, and it is getting very hard for them to get in again because they are waiting for the correction. There are people who are waiting for to get started, and it's not easy for them to get started now if they have done all the waiting. So how to deal with this? Is it time to sell? Is it time to buy? What should you do now? And I don't think there's an easy answer, but it all becomes easy if if you are able to define what do you want from your investment and what is your investment time frame. Uh, Markets will always be like this. They are volatile on a day-to-day basis. Within a day, they are volatile. Even on a medium-term basis, they are volatile. It is very hard to guess and overcome the dominant emotion that prevails in the market. Markets are either euphoric or they are going downhill, and extreme pessimism and extreme optimism is generally prevails if you look at a certain time frame. But investors, if they actually get carried away by that, it'll turn out to be very disadvantageous. All that you have in your control, and nobody has a control on this. You can't do much about what is the prevalent mood in the market, and that is something which is a big influencer. But what you have in your control and you have absolute control on is your investment time frame. If you are investing for 3 4 years, 5 years and more, then then only you should consider investing in the market, otherwise not. And investing regularly is the only other discipline that you can enforce to reduce your risk, or manage the volatility or reconcile with it. If you have these two variables in place, then whether the market is hot or cold doesn't matter. It absolutely means nothing for an investor who is investing for 10 years, 5 years and more. uh, so uh, if you have these two variables in place, which is investing regularly and investing your long term money, then state of the market doesn't matter. Maybe you should go back and stop watching market very closely on a day to day basis, because it is of no material significance to you. You can If you are investing for an investment time frame, then it just doesn't help. In fact, it will help if you get lucky with a market correction, that you will be investing cheap, you will be investing at lower levels. But you never know, the markets can be rational, or maybe be overheated for a long period of time, and if earnings catch up, there may be no correction, and that is a possibility which can't be ruled out. At the same time, convergence of some bad news might translate into huge correction, and till we have that convergence of a set of bad news, no calamity happens in the market. And even if a calamity happens, just take a look at this particular graph. This is the first graph, is the Sensex over the last 30 years, and we have had nearly about every 5 years or so, we have had this big calamity. One was in 1992, the great Indian scam led by Harshad Mehta, and looked like the market is coming to an end. The market did go up in a hurry to 4,000 levels from 2,000 in no time, and then it corrected. And that was the time when Indian economy also opened up. We had a lot of calamities. We had a lot of businesses which were becoming, which were not competitive enough. The Indian economy was thrown open for private, was opened up for any kind of competition. Then we saw the 2001 2002 crisis, the technology, the Y2K boom that we saw. The technology companies led the market. They corrected heavily and looked like the market was coming to an end. In fact, I recall the launch of Mutual Fund Insight, our magazine, and the market was at 2800 points in October 2003. Looking at that level, it looked like market has gone nowhere over the last 8-10 years, but that was for a brief period. And then we saw it not very long back. Of course, now it is 9-year-old story, the global financial crisis. Some people will recall it that the whole world was coming to a halt. The markets were crumbling. Big investment banks in the US were going down. The Europe was in doldrums, and we saw looked like market this calamity. How we will be able to get past this. And looking at this long history, we understand that it doesn't matter if you are a long-term investor, and even if you're a medium-term investor, 5 years and more, being invested and continuing to invest through these bad times was just as important. But we are talking of a different story. We are talking of a story of a situation that the market is at an all-time high. The Sensex has already crossed 30,000. The Nifty is approaching 10,000. And we don't see and the kind of inflow that is driving that is coming into the market, the way optimistic investors are pouring money, it looks as if it will be a missed opportunity if you are out of the market, and rightly so. So listen to, remind yourself of the two rules. Do you need the money in next 5 years? If you do, or if you are likely to, and if you have achieved your goal, take your money out. Otherwise not. Stick to your plan. Look at the other two graphs that we have. Sensex observed daily. So this is what you see here. But if you look at it from a 5-year perspective, if you invest in the market and see the market every 5 years, the big calamity that we mentioned, the three calamity that we saw in the market in the last 20 years, 25 years now, no, maybe 25 years, taking the first calamity in 1992. Of course, the build-up of that was in 1990, was that these calamity actually don't look like calamity. The general direction is up, and the interim volatility, the moment you take out, you end up being a winner. So discipline pays, patience pays, and staying on course is hugely rewarding. So stick to these basic rules. And if you are investing for 5-year time frame, even if you are faced with a big correction, it doesn't matter. You will be able to navigate that, use that as an opportunity. And of course, you will have some regret that yesterday your money was worth this much and today it is not as, you don't have as much worth of your investment, but it doesn't matter. Over a long period of time, you will be faced with that situation. In fact, the corrections are a very natural part of the market, and it requires a magician to be able to call the market perfectly. And I haven't come across any professional investor doing that. In fact, you are a beneficiary of the market only if you stay invested and continue investing your long-term money regularly.
Thank you, Dhiren.
Thank you.
We'll now move to the questions for today. First up, Mr. Parik asks how first-time investors should approach the current market.
As I said, and just at the sounding like a stuck record, first-time investor, long-term money, the money which you are unlikely to need for 5 years and many more years. Start with one of the two funds. If you need to save to if you need to invest to save taxes, start with a tax-saving fund. And if you don't need to save tax and you want to get started, start with a balanced fund. Choose any of these balanced fund, any of the conservative balanced fund, or tax saving fund, and do your SIP. Ideally SIP, but in case of tax saving fund, if you are approaching the kind of tax benefit that you can avail, you are left with you are not left with full 1 year. So if you can invest 1.5 lakh rupee and get the full deduction of 1.5 lakh rupee under section 80C, then spread this money over the next 8 months, 7 months, and do your SIP for that period, and subsequent year you can get started with 12,500 rupees a month. That will make up the 1,50,000 rupee annual investment that you can make and take the tax break. Else, get started with a balanced fund. Keep doing it for 2-3 years, even if you think that you should be investing in an all equity fund, because it turns out to be that investors' thinking is very malleable. The moment we are faced with a 15% correction, our mood changes, our thinking changes. We start, we are filled with, a lot of greed, fear, and anxiety, regret, happiness. So, to manage your own mind, you must get started with a balanced fund for next 3 years, and then get into an all equity fund, get used to the market, and in any 3 year time frame with a balanced fund, I'm hopeful that it will provide a reasonable experience to investors where they would have beaten the alternative investment which most investors have access to, which is a deposit. It will also be tax efficient. It will have automatic rebalancing, and all the returns that you will generate here will be completely tax free.
Next up, Biswadeep says that sales and profits of companies are down or they haven't really risen much, but the markets are still rising. So, what's driving them?
Yes, he is absolutely right. The markets, the companies are not making more money. Their earnings has not grown as we see that their stock prices. The primary driver of this market is a lot of money coming into the market. Variety of reasons. One is that foreigners are putting money because they find that India is an island of growth. Despite the lack of growth, it is it is the only market which is growing and growing at a reasonable clip. The other is the domestic market, domestic investors. Investors are putting their money in mutual funds through SIP. That is something which has come in a meaningful that has a meaningful scale now. A lot of investors are still putting money without the SIP, that they have missed the bus, or they are moving their money around. Interest rates are coming down, so many investors have been forced to look at equity. The employee provident fund has made a larger allocation to equity. The NPS has become a moderate force in the equity market, and market has sustained. A good market or a rising market also attracts a new set of people all the time. So a lot of money coming into the market, and so I don't know when it will correct, because if too much money keeps flowing into the market, markets will sustain, and everybody is quite optimistic about the structural changes happening in the economy. Whether it is GST, short term it looks like a negative, medium term and long term it looks like a great positive. India becoming a single marketplace with a taxation regime. Uh, the government's finances will improve as a result of this if it succeeds. So there is a lot of optimism and lot of flows because of variety of reason. Maybe the money flowing into the market is also a function of demonetization. A lot of people were forced to put their money into market, in the bank account, legitimization of a lot of money which was otherwise out of system. So a variety of reason, but he's right. The company's fundamentals or the earnings and profits are not growing as fast as the stock prices, and that is a worrying factor.
Deepak asks if it is better to invest in multi-cap funds or separately in large, mid, and small cap funds.
If you are able to spot a wise fund manager, it is good to put your money in a multi-cap fund. Also, because there are times when it will require rebalancing. Also, the markets are cyclical even for the components of the market. Sometimes small caps do well, sometimes mid caps do very well, sometimes large caps do well, sometimes all of them do well together. So when you invest in a small cap fund and when the markets correct, small caps crumble, mid caps struggle too, large caps prove more resilient. So these are the characters of the different components of the market. If you have a multi-cap fund, then you will have exposure to all that. You will be reasonably diversified with simplicity. If you invest in a small cap fund, it would have done exceedingly well. Today, assuming 3 years back, if you would have invested a third of your money in large cap, mid cap, and small cap, your small cap money would have doubled, and uh, large cap allocation, a third of your money would have just gone up by 1.5%, 1.5 times. If you see this difference, you might be tempted to invest in mid caps or small caps. But the problem is that when 2008 happened, the big calamity when it happened, then small caps and mid caps went down by 70-80%, while the more resilient, high quality, large cap fund went down by about 40-45%. So you lost less. And I think if you are able to spot a good fund manager, uh, give your money to a multi-cap fund. If you choose to invest in a small cap and mid cap fund, you should be deliberate about it. You have to do the rebalancing yourself, or you have to believe in that you will be investing through the lean times as well, and decide your strategy. So if you want to actually be an aggressive investor, have larger allocation to mid and small cap fund. By all means, carry on with that plan. You don't need to rebalance even, but be prepared for to absorb the extreme volatility that you will witness there. Otherwise, most ordinary investors who are seeking diversification with simplicity, multi-cap is the way to go.
On a related note, Dhiren, Vijayanand asks whether it's okay to have through an SIP a portfolio of small and mid cap funds with as much as 80% allocation.
Yes, but you should have a strong stomach to withstand the stomach churning volatility that you'll see. Right now, in the last 1.5, 2 years, or maybe 2.5 years, we have only seen the good times. Will you be okay with the bad times? If you are faced with all your accumulation in the last 2-3 years going down by 60%, 70% in 4 months' time, how will you feel? Will you still carry on with your investments? If you can, and if you have the time on your side, if you understand that well, and if you are able to spot those 3-4 fund managers who will be buying high quality small cap companies, smaller companies, but smaller companies high quality doesn't necessarily mean that in a bad market they will not crumble. They will also crack. They will actually go down in value substantially. That is the nature of that is the character of the segments of the market. So you need to be very strong hearted to have a portfolio like that. And if you are able to spot 1 or 2 small cap funds and invest 80% of your money, potentially it will be a hugely rewarding thing, given that you have the temperament for it.
This next one is from Mr. Srivastava. He asks how much weightage he should give to technical analysis versus fundamental analysis.
I'm a strong believer of fundamental analysis, and I'm a strong disbeliever of technical analysis. Technical analysis, loosely speaking, tells you, the whole theory is that it will try and tell you, is it a good point to make that investment. I think, given the investment philosophy which we follow, which we think most common investors can understand, technical analysis is a short-term trend. Maybe it will be useful for somebody who is trading, but if you are a long-term equity investor, fundamentally is all that matters. If there is a great company which is going to make more money and it is managed well, managed by a good set of managers, and supported by a great set of founders, nothing like it. Everything else falls in place over a period of time. Uh, Technical analysis primarily doesn't care about what is going on in the business. It is looking at it is basically the art or science of looking at the price chart, trying to spot a trend, based on the actions of many investors. So uh, it might be misleading. I don't think on a long term basis. The biggest problem of technical analysis is that what you tend to believe in technical analysis, that it will help you spot a change in trend, that it fails to.
Next up, Mr. Pradhan says that he invests in mutual funds through the various websites of mutual funds. Is it possible to do it through a single portal?
Yes, it is possible to do most of your transactions for multiple funds through mutual fund utility. And there is another way around it. If you continue to invest through various portals, you can still get a consolidated account statement on demand from CAMS and CARVI, the registrar and transfer agents of mutual funds. You can go to their website, get a consolidated transaction statement or account statement, a status report from that. And at Value Research Online, you can upload all that PDF file that you get from them, and you don't have to input the portfolio yourself. So monitoring and tracking your investments is consolidated. Otherwise, you can do it at mutual fund utility, and tracking your investments at Value Research Online through that consolidated account statement which you get from CAMS and Carvi is not very difficult. All you have to do is upload your consolidated account statement, like you do, like you attach a attachment to your mail after registering at Value Research Online, and everything else is taken care of. All your purchases, sales, SIPs, STPs, withdrawal, and we calculate. We give you the daily, the valuation. You go to the My Portfolio section and you get the valuation on a daily basis. In the XIRR, the rate of return on your series of SIP, an analysis of your portfolio on an aggregate basis. It also takes into account your stock portfolio, and it all happens without you inputting or typing each and every transaction that you have made in your investment life.
While you prescribe an investment strategy where market levels don't really matter, Dhiren, but still people have concerns, and this next question is linked to that. Priyesh asks if he can hedge his mutual fund holdings by selling Nifty futures.
Don't do that. It will only cost you money, and it doesn't matter if you're, and it will not save you a lot of money, because you have to be right with that. And look at the cost. Look at the cost. It is almost like buying insurance, and look at the cost of buying that insurance today.
Moving on, Mr. Jadhav asks if it is better to invest in new fund offers than existing funds.
No. In fact, when you invest in mutual fund, all you have is its past track record. Past track record, not from a standpoint of how much return it has given to investors in the past, but primarily how it has behaved at different points of time, so that you are prepared for how this fund has done, what it follows. And when it comes to a new fund, you don't know anything about it. And my guess is that most new funds, they start with a if unless there is a special kind of fund which was not available to investors before, it is avoidable.
This next question comes from Jenin. She asks how short term and ultra short term debt funds will be affected by further rate cuts.
Short-term debt funds will get affected a little bit. Ultra short-term won't be. Of course, if the rate cuts happen, the long-term return in the system declines, falls over a period. So we have seen that even liquid funds and ultra short-term bond funds were generating 8 or 9% 2 years back, and they are coming down gradually. And if interest rates go down, they will be generating 0.5% less or 1% less, depending on less expenses. The return generated by the money market instruments, less expenses. And the short term bond fund, they will come down, but in the medium term, in the short run, they will also benefit a little bit, because that those portfolios are made up of medium term maturity and short term maturity, and because of which the medium term maturity papers will also have some appreciation, so they will generate some return in the short run, higher return in the short run, and over a period of time, the return will settle down to lower levels than they have done given in the past.
So Dipta asks where he should park the money he wants to use to buy a car in the next 2 years.
2 years, this amount of money, if he already has or most of the money, then he should invest in a ultra short term bond fund, or a relatively lower maturity short term bond fund. That should do, and the difference between the two will not be very meaningful if it is a sum of 3 to 5 lakh rupees. And if you are still saving regularly for next 2 years, maybe it's almost like a recurring deposit. This is where the SIP in these bond funds will also make sense. But because it's an investment of less than 2 years, you won't have any tax efficiency here. The tax treatment, the beneficial tax treatment of investing in a bond fund comes only if you hold it for 3 years, because that is when the indexation benefits. Your investment is indexed, and then you pay the taxes only on the indexed gain.
This next one is from Mr. Jashnani. He says that the last recession took place in 2008, and since economic cycles last for about 9 years, is another one round the corner.
I don't know. because the environment is so dynamic and so many external things are happening, and the world is so connected that it's very hard to make a theory about a timeline of a repeat of a recession. So I don't know, and I don't think we should start believing in any principle or any such theory that every 9 year or every 7th year some such thing happens, because the world is extremely unpredictable given the changing dynamics. If we see, if somebody just woke up after 25 years and gets up from his sleep after 25 years in India, I think his world would have completely changed in terms of the kind of company, the way we are structured, the way we see our surrounding, the way businesses conduct now, the way businesses used to be. So there are just too many things happening. We are too connected. If I just look at the last 25 years or 10 years or 5 years, uh, the way we were as an economy in 1990, the way we were regulated, the way our markets used to function, the way foreigners are investing in India, the way Indian investors have their behavior has changed, the way they are investing in India, the way employee provident fund is putting money in equity, NPS has come into being, which is channelizing all the money of new government employees since 2004 into market, a part of it. So the whole world has changed, and we should not get into a theory. Yes, I have a deep belief that good businesses do well and they change themselves over time, and that is what the focus of any investment or any investor should be, and optimizing your return based on the risk that you can tolerate. You should configure yourself around it. The rest of the things we don't know.
We'll take one last question for today, Dhiren.
Sure.
Aniket asks how mutual fund investment differs from investing directly in stocks, and how much could be the difference in their returns.
Mutual funds gets you convenience. With 5,000 rupee you can diversify. A person is responsible for looking at companies, what to buy, what not to buy, and get you instant diversification. That is all there to it. Convenience, diversification. But if you have the time, if you have the inclination, and if you are a good investor, and you are also lucky, because there is always a component of luck and rigor, which translates into superior performance. So you stand a good chance. But it's important that you are fundamentally guided. You understand what you are investing in. You are able to ask those questions, satisfy yourself with an answer. Then, when building a stock portfolio, 2 3 things matter. One is that you are able to spot a good company at an attractive price, which will outlive, about which you don't have to bother it, and it is free from the risks of poor management, which steals money from the company, which is able to manage, keep shareholders' interest ahead of their petty short-term interest, and it is in a good business segment which is doing well and has the potential to grow and become a scalable, larger business over time. If you are capable of doing all this, you stand a great chance of being an equity investor, a good equity investor. And if till you are learning, do it with a small part of your money. Try your hand. Largely get this benefit of diversification and convenience till you are confident of doing it yourself. I think most investors, and the bigger problem is, if you want to be an equity investor, one is to do these things, but more important is not to do the bad things. When you get into stock, buying stocks yourself directly, you end up there is a great likelihood that you end up being a speculator. You are being bombarded with lot of stock ideas, lot of short term stock ideas, momentum stock ideas. You will be given some idea every day which is trading stock ideas, because there is a huge conflict of interest. Your brave broker wants you as an investor, you will benefit only if you buy some great companies and hold it for a long period of time for it to multiply and compound your money, while your brokers wants you to buy and sell every day. So here is a because he makes money only when you buy and sell more often. And if you are able to overcome all those, the kind of invitations or provocations that you will see to trade and buy into momentum stocks and do all the kind of things which a good equity investor should not be doing. If you are able to do get into that with clarity of mind that what you are there for, what you will do, then only you should consider investing in stocks directly. Otherwise, for most ordinary investor, investing their small sums of money to accumulate something meaningful over a period of time, mutual funds or equity mutual funds turn out to be the best option.
Thanks, Hiren.
Thank you.
That brings us to the close of today's session. Any closing remarks?
Yes, don't get worked up on this heated market. Stick to your plan, and that is all that matters. Markets are always like this.
Thank you, Hiren. Thanks everyone for joining in.
Thank you.
Do join us next week as well for another edition of Money Hangouts.